Well, hello, and welcome to Module 2, Stock Options. I've had some feedback on the prior module, and I wanted you to know that it's okay if you didn't fully understand everything in the module. We will be going through a review, and understand that this is new to you. This is something you haven't done before. Remember when you first drove a car? And you had so much difficulty. Where do I look? Do I look here? Where's my mirror? How do I adjust my mirror? How do I go? How do I go fast? How do I go slow? Where's the brake? Where's this? Where's the parking brake? What do I do now? Oh my goodness! Oh my goodness! Oh my goodness! Well, remember that if you're new to stock market and you're new to stock options, this might not you might not catch it right away. So don't be afraid if you don't understand it. You still have access to me, and you have access to me through email and through text messaging, and of course you can replay the videos over and over again. So today, some of the things you're going to learn today will be: what are stock options? What are the different types of options? How are options priced? And how to find the current prices of options using a TD Ameritrade account is what I'm going to show you, but of course you will be able to use some of these techniques in other trading platforms if you don't want to use TD Ameritrade. Okay. So I have some suggestions for you. Remember, I mentioned it before, this is new for you. It's okay if you play it back a few times, rewind it. Don't worry, you will get it. I promise you, you will get it. Okay? Don't get frustrated. All right, I'm also going to tell you to have your TD Ameritrade account open on another screen so you'll be able to play along with me. And of course, have a piece of paper and a pen and take notes. And once again, don't get frustrated. Okay, it's disclaimer time again. Once again, as you know, you can lose money in stock options. I'm telling you that I will do everything I can to prevent that, but I can't promise it's not going to happen. However, remember that stock options trading means that small market movements will have a great impact on your trading account, and this can work against you, leading to large losses, or it can work for you, leading to large gains. All right, let's review some facts of the last webinar. First of all, stocks are ownership. If you own the stock, you own a piece of the company. And if you remember, we talked a little bit about what makes stocks go up or down. And literally, these are the things that make stocks go up or down. It really is the fund managers and their fear and their greed. It's that simple. If you remember the chart, we had this chart and we showed that when the stock is getting really high, the fund managers start to get fearful that they're going to lose money for their clients. When the stock goes really low, well, once again, they get greedy and they say, hey, I better buy now because I'm going to make a whole lot of money for my clients. Remember that these small movements are the options trader's money-making opportunity. By the way, greed is also called support, and fear is also called resistance. We will use these words in some further webinars, and they're good for you to know. The other thing that makes stocks go up and down is earning reports. Earnings are quarterly, and they're announced a month after the ending quarter. If a company does well in earning, typically the stock goes up, but not always. I've warned you before that betting on earnings is gambling. You really don't know what the earnings are going to be. So betting on earnings is pure gambling. All right. Stock options are not ownership of the stock. You do not own the stock. You own the right to buy the stock at a specific price. That's what an option is. So why stock options? Remember, stock options use incredible amount of leverage to control stocks without ever owning the stock. Now, if you read the ebook, and I hope you did, you saw the house example that was in the ebook, and I'm going to go through it a little bit more with you with a little bit better detail. And remember, let's say you have a house that's currently worth $100,000. I come along and I think the house will be worth $150,000 in 3 years. But I can't buy it now, or maybe you don't want to sell it to me now, but I want it. You think the house will be worth $130,000 in 3 years, so we discuss some ideas. I offer you $10,000 now to enter into a contract with you to buy your house at $130,000 within 3 years. So that means for the next 36 months, I could buy your house anytime for $130,000. Now, obviously, I'm not going to buy the house tomorrow because it's still only worth $100,000 tomorrow. But if I think that in 3 years it's going to be worth 150, hey, if I could buy that house at 130, that's a pretty good deal. So now you get to 10,000 now. You put it in your pocket. It's yours. You spend it any way you want. But my contract with you says that you can't sell it to anyone else unless I let you out of the contract or if the 3 years expires. So 3 years and 1 day later, if I didn't buy the house, you can now sell the house to anybody you want for any price. All right, if in 3 years I was right and the house is worth 150 or more, my contract with you says that you must sell me the house for 130. I make $20,000 equity immediately when I buy the house. Of course, I paid $10,000 for the option, so I'm really only ahead $10,000. However, if in 3 years I was wrong and the house is worth 130 or less, my contract with you says that you must sell me the house for 130. But since it's worth less than that or equal to the 130, I pass and I don't buy the house. And you get to keep my option money. So basically, I lost $10,000. Okay, what are my options? First of all, anytime during the 3 years I can buy the house. Anytime during the 3 years I cannot buy the house. That's literally what the option is. Buy it or not buy it. Now, here's the other option, which is sell the option, or the other choice. I hate using this word option over and over again. So the other choice is sell the option to a third party. In fact, this is how I make money in stock options. I sell my option to someone else. So I want to talk about some definitions. So first of all, buying the house is called executing the option. So I executed the option, I bought the house. Not buying the house is letting the option expire. And third, selling the option is selling the option, right? I can sell the option anytime before the expiration date. All right, here are some more important definitions. And these are things you might want to write down and memorize. The strike price, time value, and intrinsic value are things that are very important in stock options. So first of all, the strike price in the example of the house is the price I could buy the house for. In this case, the strike price was $130,000. The contract says I'm buying the house for $130,000 if I decide to execute the contract. That is the strike price. It doesn't matter if a builder comes along to the owner and offers him $1 million for the property. I have the right to buy the property to $130,000, and he can't sell it to anyone else because that's what my option says. So the strike price is the price I could buy the house for. In this case, $130,000. Time value is the money that you're willing to risk to have the option to buy the house within the 3 years. Basically, this was the $10,000. If the house was only worth $100,000 when I took the option for $130,000, so basically I'm buying time with my $10,000. So I'm saying I want 3 years' time to lock you into a contract to buy your house for $130,000. The time I'm buying is $10,000, or I'm buying $10,000 worth of time in this case. Okay, this is something you need to understand, that you're buying time with your $10,000. It's a time value. The next thing is intrinsic value. Now, the intrinsic value is the actual value of the investment at any given time. In the example we discussed, there is no intrinsic value. However, if a year later the house was worth $135,000, I would have $5,000 intrinsic value. In this case, it's the difference between the strike price and the actual value of the house. Let me go through that with you one more time. So we have the strike price is $130,000. That's that price I could buy the house for. The house value is $135,000. That means I have $5,000 intrinsic value. Now remember, I still paid $10,000 for the option. So even if I bought the house tomorrow for $130,000, I'm still behind $5,000, but I'm not behind $10,000. Get it? So the intrinsic value of this option is $5,000 if the house value is selling for $135,000. Now, in some cases, there could be intrinsic value right from the beginning. Now, let's take a different scenario. Let's say the owner will sell me the option to buy the house for $90,000 in 3 years. Now remember, this house has a current value of $100,000. Now, his option price is 20,000. Now think about this. He's saying that he wants to sell me the option to buy the house at $90,000 for $20,000. So 90 and 20 is 110, right? So what he's basically doing is he's saying, well, yeah, I'm going to give you some intrinsic value in that option. So right from the start, it's worth $10,000. Get it? The current house price is $100,000. I can buy the house for $90,000, so I have $10,000 worth of intrinsic value. So let's take a look at this again. The strike price is $90,000. The house value is $100,000. The intrinsic value is $10,000. Now remember, the option price was $20,000, and this cost includes the $10,000 time value. So I have $10,000 intrinsic value, and I have $10,000 time value. So stock options work just like the house example. It's exactly the same. So let's go through it. Okay, if COT stock is trading for $10 a share, let's use the example that I buy the option to buy the stock at $10 and I pay $1 for this option. So I'm locking in the price at $10 and saying that I can buy this from you anytime for a certain period of time. Let's say it's 3 months. I have 3 months to buy the stock from you for $10. And I pay you $1 for this option. So your contract says you can't sell the stock to anybody but me for the next 3 months, and you have to sell it to me for $10 anytime in the next 3 months. So I paid you $1 to buy the option to do this. If the stock goes up, for example, to $12.50 a share, I made $1.50 profit. Let me go through that with you. So if it's $12.50, which is the current value, minus the $10, which is the price I can buy it for, that equals $2.50 gross profit. Get it? $12.50 is the current price. I could buy the stock for $10. I make $2.50 gross profit. But remember, I paid $1 for the option, so my net profit is $1.50. Not bad, actually, for a 150% return on an option is awesome. And you know what? This does happen in options, and I'll show them to you in the future. So here's my choices with options. Remember, we talked about this before. If I buy the stock, I can execute the option. I cannot buy the stock, which is basically let it expire. So, for example, the stock went down to 9, or let's say something went down to 9, or it went down to 9.5. Well, if I could buy it at 10, why would I want to buy it at 10? If I could buy it on the street for $9.50, why would I want to buy it from you for 10? So I let it expire, and you get to keep my money. Or, my favorite is sell the option anytime before expiration. This is the key to stock options trading. You buy low and you sell high. All right. The type of options that we've been discussing is called a call option. With a call option, we are betting on the stock price to go up, or the house price to go up, or whatever it was that you're buying a call option on, you're betting on the price to go up. Okay? There is something called a put option. It's another type of option, and I don't really want to discuss it in this webinar. We're going to discuss it in the next one, but we're betting on the stock price to go down. But be aware of that. Be aware of the fact that there are call options and put options. Call options are going up, put options are going down. You want the market to go down. Call option, you want the market to go up. Put option, you want the market to go down. It's that simple. In fact, I had someone who had explained this to me many years ago, and the way they explained it to me I thought was great. When the phone rings and you pick up a call, you pick up the call, it goes up, right? When you put the phone down to hang up. So you want you put the phone down, it goes down. You pull the call up, it goes up. Okay, anyway, so put is down, call is up. All right, let's talk about pricing an option. Now, you have to understand that an option price is made up of two parts. And we kind of talked about this a little while ago, but let's put it in perspective and let's make it as real as possible. There are two parts, the intrinsic value and the time value. And basically, the time value plus the intrinsic value is equal to the price of the option. So let's go back to that house example again and watch this. If you remember, the strike price was $90,000. The house value is $100,000, so it has an intrinsic value of $10,000. The option price was $20,000. This includes the $10,000 time value, which means we have intrinsic value of $10,000 and we have $10,000 of time value. So we have intrinsic value is $10,000, we have time value of $10,000, the option price is now $20,000. All right. Now, if you've opened up your TD Ameritrade account, you may want to kind of follow along. And if not, it's okay. You don't have to. But if you can, maybe if you open this up in a different venue, maybe in your portable device, and you're watching along with your TD Ameritrade account open on your computer, that's great because it might be easier for you to see this and see what's happening. But I'm going to take you through it and see what happens. Okay. So there's something on TD Ameritrade called a snap ticket. It's actually at the bottom of your screen. And if it's not up, you just hit this button right here called Snap Ticket, and then you'll be able to open it up and you'll be able to see what you're seeing right now. And then what we're going to do is we're going to go to what's called the options chain. And I'm going to talk about what an options chain is. Basically, an options chain is basically just a supermarket shelf of options. So what you're going to do is you're going to put in the quote of what company you want to run options on. So my favorite is still Facebook. So if I want to get the options chain for Facebook, I type in FB, don't hit quote, it actually will give it to you anyway, but don't hit quote, and go over to the right side and click the chain button. When you click the chain button, what's going to happen is you're going to get a screen that looks like this. All right? Now, it looks complicated, but don't worry because it's actually pretty easy because there's only certain things in the screen that you need to know about. So the first thing I want to just show you is, once again, we're looking over here, you're going to see the chain type is calls and puts. But right now we're talking about calls, and that's all we're going to talk about on this module. But understand that you're going to see both when you do this. So the underlying symbol is Facebook, and again, we're looking at calls and puts. Now, if you go down to any one of these, for example, let's take a look at this one, FB March 17, 2017. That's the date of the expiration. March 17th is the date of the expiration. And if you look to the right, it says 52 days to expiration. So you can actually figure out what day I took this screenshot. But anyway, the reality is how far away do I have to go before the option expires? So it's 52 days to expiration. Okay, now take a look at this. As you know, that this would be, for example, this would be February 24th, would be 26 days for expiration. This would be February 3rd, from this date, which would be 5 days to expiration. Or this one would be 47 days to expiration. Now, as you could probably tell, the longer the time, the more time premium you will pay. So when clicking for options, understand that the further you go out, the more expensive they're going to be. Makes sense, right? Because if you're only buying 5 days to expiration, there's not a whole lot of time for you to make decisions. So you've got to say, hey, look, in 5 days, I don't have a lot of room for that stock to move up and down. But in 47 days, almost 10 times that day, I have almost 10 times the days to make up for a mistake or to be right. Okay, now if you were to click this button, see the plus sign right there on this option? If you click that button, it'll expand. And when it expands, it looks something like this. All right? And then you see you have a bunch of things here. One side says calls, one side says puts. We're going to concentrate on the call side right now. And that's what we're going to talk about right now. And again, this is Facebook March 3rd, 2017. And according to this, the day that I ran this, there are 33 days to expiration. Now you'll see at the bottom, I wrote that Facebook was currently selling for about $132.45 in this, in this example. So if you look, you can see that you can buy options that have intrinsic value, or you can buy options that don't have intrinsic value. So for example, the 130 call, the 130 call, which is the strike price, 130 is the strike price, has $2.45 intrinsic value in there at this number. But if you look at the 135 call, it has no intrinsic value. So you can see, by the way, If you haven't noticed already, the ones in yellow have intrinsic value. The ones in white have no intrinsic value. So the ones in white, you're paying for pure time. The ones in yellow, you're paying for time plus intrinsic value. Now we're going to get into, in some further webinars and some further modules, we're going to get into when you should buy with intrinsic value and when you should buy without intrinsic value. Now you do understand that with intrinsic value, they're going to be more expensive, of course, but sometimes they're safer. And by the way, this is the strike price. So these strike prices, 130, 131, 132, 133, 134, 135 are strike prices that you can buy the stock for guaranteed. So if this stock goes to 150 and you have a strike price of 135, you did really well, especially if you paid $3.30 for it. Okay, the next part of this chart, again, for Facebook March 3rd, 2017, is the bid and the ask price. These are the prices you're going to pay for the option. Now let's talk about the difference between the bid and the ask price. And you can see there is a difference between the bid and the ask. And it's very simple. The bid price is the price someone is willing to pay for this option currently. The ask price is how much someone is asking for the option. So it's a negotiation. Just like if you were buying a house that was listed for $100,000 and you make a bid of $90,000, you might meet in the middle for $95,000. So your bid is 90, their ask is 100. Maybe you meet in the middle for 95. Okay? So if you take a look at this again, the 130 call has two prices. It has a bid price of $5.70 and an ask price of $5.85. Someone is saying, I'm going to pay $5.70 right now for this. Or if you take my money, it's your, I'll take it from you. Somebody else is saying, if you give me $5.85, you could buy it right this second. Now, the difference between those numbers is called the spread. And in this case, of course, the spread is 15 cents. Now, it's not all that important that you know the term, the spread, but it's nice to know to talk about. Maybe if you see a really small spread, you might say, hey, wow, this option is moving pretty fast. And believe it or not, a 15-cent spread is a pretty big spread in an option. I'm kind of surprised we're seeing a 15-cent spread here, but that's just the way it is. You'll see that kind of spread. You'll see that kind of spread on certain options, and you'll see a less of a spread on certain options. I know I've seen options with a spread of 1 cent, which blows my mind that they're that low. All right, let's go back to this options chain, which is where we were before. And again, we're still in February, March 3rd, 2017. And we clicked that button and we got there. And when you click that button, you're going to get something else. Actually, you already expanded it. Now you're going to click the button to 130.0 call. You see how it's highlighted blue? That's a link. And when you click that link, you're going to come up with the full pricing of an option. So just to give you an example, in this example, the day I ran this, you can tell it's a different day. The day I ran this, Facebook, the stock, was selling for $127 was the bid price, and the ask price was $127.07. Now, there's also a bid and ask and a spread in just the regular stock. So this is the regular stock. The stock is selling for $127. Or actually, it's selling for $127.07, but someone is willing to give $127 for it. But when you click that button that I showed you before, that link, you're going to get this. And this is the explanation of the kind of what's going on in the back of the stock option. So let me show you what all this means. Okay, first of all, remember that we had an ask price for the stock of $127.07. So if somebody wanted to buy the stock, they would have to pay $127.07 for the stock. All right? Now over here, we have the expiration date and the strike price. All right? So we have the expiration date of this option being March 17, 2017, and it's a 125 call. So it's a 125 strike price, and of course, call means we want the stock to go up. Here is the current bid and ask. So someone says, hey, I'll pay you $6 for this option for a 125 option. A 125 strike price option That expires March 17th, 2017. All right. However, somebody else is saying, well, I want you to pay $6.15. So they may meet in the middle. But either way, let's go through this and see where this goes. There's something else here, remember? See, time value. Remember we talked about time value? That's what's important. How much time value are you paying for this? Now watch this, how the price of the option is calculated. It's very easy. Okay, once again, we have the ask price of the stock is $127.07, and it's a $125 strike price call, which means that inside this option, if I was to buy it for $6.15, which is the ask price, if I was to buy it, I would have an intrinsic value of $2.07. Get it? $2.07 is the difference between the ask price of the stock and the strike price of the option. So my intrinsic value is $2.07. Okay, now we have time value. And the time value is the amount of money we're going to pay for the option, the ask price of the option, minus the intrinsic value of $2.07, and we get $4.06. Look at that. The math worked. It's actually a time value of $4.06. That's what you're paying for. By the way, the time value is also referred to as the premium. So sometimes people will say, oh, the premium on that stock is $4.06. That means time value. So those words are interchangeable. You may hear me using it and saying different things. All right, remember, the option price is the time value plus the intrinsic value. Now, time value decays every day. So think about this. The closer you get to the time expiration date, the more the value of the time goes down. So if you paid $4 today, it might be $3.90 tomorrow. It might be $3.80 the next day. So the time value decays. So if the stock doesn't move, for example, and it stays at exactly the same price, you're losing money because the time value is decaying. Now, the intrinsic value changes with the price of the stock. Makes total sense, right? If the stock goes up 2 points, the intrinsic value goes up 2 points. Now, even if the time value decayed because of time and the stock value went up, the intrinsic value went up, so that means that your stock option is still worth more money than it was when you bought it, assuming the intrinsic value goes up more than the time value decayed. All right, I know I said a mouthful, it's okay. I promise you that you're going to get this. And the funny part is, within a month after you're trading options, all of this is going to make so much sense to you. You're going to be like spitting these words out back and forth, like, oh yeah, the intrinsic value was this, the time value is that, the premium is this, blah, 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 blah. And we're going to be having those conversations, so don't worry. Like I said, hit rewind, go through it a couple of times. It's not a big deal that you don't fully understand it yet. Remember, you're new at this. Okay. Remember one other thing about time value that's really interesting, that time value doesn't always decay. Now, this is kind of weird, and I'm going to put this out there, but I'm going to show you to you and explain it to you more thoroughly in further modules. But in case you're watching this, or in case you're following a stock, or in case you're following a stock option, you may notice that the time value actually increased instead of decaying. And this typically happens right around earnings seasons. The reason it happens right around earnings season is because people are getting to earnings and they're kind of gambling on earnings and saying, well, Facebook's going to have a great earnings and, the articles are coming out. So people are saying, well, we want more money for our stock option, and they can only charge you in the premium. They can't charge you in the intrinsic value. So just understand that sometimes time value actually goes up during earnings seasons. In fact, it quite often goes up during earnings seasons. And one of the advanced techniques, and I'm not going to teach you in this module, but one of the advanced techniques is actually not even worrying about the intrinsic value, but worrying about the time value and using the time value to make money. Remember, you just want to buy the option at this price and sell the option at this price. So, and hopefully that price that you're selling it for is more than you paid for it. And that's why some people play that earnings season time value play. And again, it's a more advanced lesson, and I promise you we will get into it in some further modules. Okay. I'm going to stop here because I'm afraid that I'm giving you too much. So what I want you to do is, of course, review this a few times. And I want you to look up option chains. I want you to understand option chains. I want you to review the module over and over again just so you get it. And then, of course, I want you to study how the price of the option goes up or down with the price of the stock. Watch it. I know you're going to think right away that, hey, if the stock goes up $1, then my intrinsic value, my stock option price goes up $1. Well, it actually doesn't. I'm going to explain why again in other modules, but I want you to start to notice it. I want you to see that if a stock option price intrinsic value goes up, it doesn't mean that the value of your option went up that dollar. And really, what the reason is because the time's decaying, but I'm going to explain it more thoroughly in more modules. So relax, just watch some stock options, maybe even, technically paper trade. And you can paper trade using accounts, but technically, all you need to do is just take a piece of paper, write down how much you would buy the option for today, what the time value is, what the intrinsic value is today, and look at it 4 days later and see what the difference is. That's a really good way to fully understand what you're seeing. So when you pull up the options chain, you pull up an options chain for such and such a day, such and such a stock, and you study it. Again, don't go crazy. It's okay that you don't fully understand this yet. I promise you, like I've said before, I've shown this to quite a few people, and they didn't get it. And then all of a sudden, within 2 or 3 weeks of trading options, like, oh, yeah, I get it. And you will get it too. I'm Larry Steinhaus. I am the Crazy Options Trader. By the way, if you haven't already downloaded the rules of the Crazy Options Trader, I want you to know that you have access to them. Even if you didn't buy them prior to buying the modules, you now have access to them. And I want you to download them and I want you to read them. They actually will start to make some sense after this module if they didn't make sense to you before. So make sure you take a look at the rules if you haven't already downloaded them. You get them. If you're watching this module, you already have access to them. So make sure you download them and take a look at them. And by the way, the rules, if you're really following them, the rules will tell you when to buy, they'll tell you when to sell, and they'll keep you from making a greedy mistake. And most importantly, they'll keep you calm when the market turns the wrong way. So that's why I want you to download them. I want you to read them. I want you to see them. I want you to enjoy them. All right, that's it for today. I am Larry Steinhaus. I am the Crazy Options Trader. I am looking forward to talking to you again. Have a profitable week.